This might be the greatest setup ever for the cryptocurrency markets. On the surface, the US economy looks unstoppable, but dig into the data and a very different story starts to emerge. And here's the deal. Whether it's stagflation or some kind of brand new business cycle, both roads lead to Bitcoin. So stick around, because by the end, you'll see why this setup that we're looking at right now could be extremely explosive. Now, most of the time when we talk about the US economy, we think about the S&P 500, which of course the index, the 500 biggest publicly traded companies in the United States, the standard barometer of economic health. Are the stock markets doing good? Yes, pump it all forever. But there's another index worth watching, the Russell 2000. It tracks 2,000 small cap companies and sits inside the Russell 3000, which measures the 3,000 largest US companies overall. In simple terms, the Russell 3000 gives the big picture. The Russell 1000 covers the largest firms, including the S&P 500. The Russell 2000 captures the smallest 2,000, while the S&P shows how the giants are doing. Now, the Russell 2000 reveals something very interesting, because when the little stocks start doing good, that's a signal for risk. And it can be a leading signal for broader risk appetite in the markets, particularly for things like dog coins, okay? And if you think about it, if people are investing and they're looking at these smaller cap stocks for outsized gains, then why not spin the wheel in the crypto casino? Right? Well, let's look at some charts making the rounds on social media. The first one comes from Max Because BTC, who highlighted a correlation between the Russell 2000 and the cryptocurrency markets. His chart showed that right after the Russell 2000 broke its previous all-time high in 2020, Dogecoin pumped super mega hard. Now, let's take that idea a step farther. We've got our own chart here comparing the Russell 2000, the crypto total market cap excluding Bitcoin, Ethereum, and stablecoins, called the Total 3ES. And we're also going to throw in here the total market cap excluding the top 10 coins, often called the Others chart. Now, last time the Russell 2000 hit an all-time high in Q4 of 2021, remember that, those are good times, both the total E3ES and the Others also ripped to new highs almost simultaneously. What's more, that level turned into swing high resistance in Q4 2024. All three tried to break through again and failed. All three peaked at almost the same time. Now we're back at that line. In the next few days, this resistance will either hold or finally break, which means by year end, we're either looking at another peak or popping champagne on a breakout. I know what you're thinking. Which way is it gonna go? Well, one possible clue comes from an interesting post by Decode Jar. He shared a chart showing a breakout on his custom macro oscillator versus the total 2ES, or the crypto market cap excluding Bitcoin and stablecoins. The indicator pulled in data from 40 public sources and distilled them into 19 macro indicators. He then runs them through different modes, with Pulse being the most sensitive and leading version. According to him, Pulse tends to pick up turning points earlier than the broader market. Right now, it's flashing a breakout. And you've noticed on this chart, it is also forming an ascending triangle, which for all the chart analysts out there is usually a bullish setup. Now, if that signal is right and it lines up with the idea that the Russell 2000 and the crypto market cap might not stay stuck under this resistance for much longer, then hold on to your butts, because things could get exciting. Now, before we get into the rest of the charts here and the rest of the story, guys, when it comes to trading, Femex is an exchange that just keeps delivering deep liquidity, worldwide access, meaning anyone, anywhere, that's you, can use the exchange, rock solid security. And right now, they're giving you more reasons to jump in. Deposit $200 or more, trade one time, you'll walk away with $50 instantly. On top of that, there's up to $800 in trading rewards waiting for you, plus a bonus of 1 Solana if you hit the top tier trading requirements. And here's the kicker. 5 traders this month will each win 1 Solana. So if you're serious about crypto, never been a better time to make the move. Go check it out. Link down below. Let's address something bearish, at least for the US economy. It turns out that the previous jobs data was extremely off. In a nutshell, the Bureau of Labor Statistics announced a major revision showing that 911,000 fewer jobs were created between April 2024 and March 2025. One of the largest downtrend adjustments in decades. Yeah, almost 1 million more jobs than never actually existed. That's insanity. WTF, right? So is this good or bad? Well, it depends on your perspective. From an economist's point of view, it's bad. Jobs have always been a key indicator of economic health. When jobs markets are bad, it tends to come before, well, bad things happening more broadly in the economy. When you have more jobs, as more companies hiring, expanding people, fewer jobs means less expansion, right? We've seen expansion on things like the ISM PMI relatively flat recently. But here's a silver lining for markets like crypto. This could force the Fed's hands to cut rates even harder. Remember, the Fed's dual mandate is to ensure maximum employment and stable prices. So how do you boost employment? Well, one way is by encouraging business expansion that often comes through lower interest rates. Cheap money allows companies to borrow for growth, hire more people, fuel economic activity. It might lead to inflation. That's the problem, okay? Because inflation has been slowly creeping its way back up, which is an uncomfortable reality. The U.S. annual inflation rate jumped to 2.9% in August 2025, the highest since January, driven by faster price rises in food, used cars and trucks, and new vehicles. Energy costs also ticked up for the first time in 7 months. With natural gas still elevated, while core inflation remains steady at 3.1%, signaling that underlying price pressures are sticky. You put weak jobs together with rising prices, and you've got the classic recipe sitting here for stagflation, which is a nightmare for policymakers, but a possible narrative tailwind for Bitcoin. Another big catalyst for crypto could come from ETFs. Of course, the Solana ETF deadline is in just a few weeks away, less than 30 days at this point, with approvals for others likely to follow soon after. That opens the door for institutional money to flood in, adding liquidity, adding narrative power, and maybe even triggering, well, some kind of altcoin impulse, let's say. I know I like to use the word altcoin season, but it feels cursed at this point. A broad altcoin rally sustained for more than a few hours, that would be something, wouldn't it? On top of that, the macro backdrop is looking better than ever, at least for degens like us. Bitcoin and the DXY, or the US dollar index, have a well-known inverse correlation. The dollar has already seen increasing weakness throughout the entirety of the year. According to an August Morgan Stanley report, the decline is expected to continue further, with the DXY potentially dropping another 10% by the end of next year, which opens the door, just kicks the door wide open for risk assets to go up in price. At the same time, Bitcoin exchange reserves keep falling, which is another bullish signal. We have Ethereum ETFs picking up. We have the whole digital asset treasury company trend. I mean, come on, man. So let's put the pieces together. We got the Russell 2000 and crypto on the brink of a breakout. These things correlate very closely because risk assets, whether low cap stocks or crypto, tend to move around the same time. A jobs market that suggests the Fed should have to cut rates yesterday, but will probably cut rates, well, tomorrow, which is good. Inflation that keeps the hard money narrative alive, ETF approvals plus institutional liquidity just around the corner, and here's the kicker. All that demand side fuel builds, the supply side continues to tighten. Bitcoin exchange reserves keep dropping. Digital asset treasury companies keep up buying ETH and Solana and Bitcoin, which means fewer coins available for the regular public. A setup that has historically preceded major moves higher. The thesis remains we're likely to see at least a local top by year's end, with a real possibility of an extended cycle stretching well into 2026. Of course, nothing in markets is ever guaranteed. Take profits when you have them. But step back for a moment. All this puts us in a unique spot. Bitcoin, a true hybrid asset, is made for these kind of conditions. When TradFi markets pump, Bitcoin rides the wave, but if the economy cracks and confidence in the dollar breaks, Bitcoin flips into a potential safe haven asset. It's both a risk asset and a potential refuge, depending on what the moment calls for. And it's very volatile, yes, but it fulfills those functions. And remember, when Bitcoin moves, the rest of the cryptocurrency market follows. Now, I can't tell you what to do with your money. It's not the point of this channel. But I'll say this. I am not pulling out just yet. I'm riding the wave, and I think this wave's got a lot longer to take us. Thanks for watching.